Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel L. Connon, along with Dennis Dick, and we have a special guest on today, Paul LaMonica. He's a digital correspondent at CNNMoney. Paul, how you doing today?
I'm good, thanks. Thanks for having me on again.
Our pleasure. So, a little bit of volatility here in the market coming from a couple different sources. Is this going to mess up the Santa Claus rally?
It appears that that might be the case. I mean, right now it seems to be all about oil, and you're looking at oil below $60 a barrel. A lot of energy stocks are tumbling on this, and I think right now people seem to be more worried about what the oil prices say about the global economy than encouraged by the fact that it could be a boon for U.S. consumers and it could help retailers and airlines, et cetera.
I often follow your tweets there, and I know you actually tweet out on stock twits as well, and you're a big fan of kind of following what is being said in the social media. Are you feeling that everybody is maybe too bearish oil here? Because like I see on CNBC, you see everywhere, everybody's like, oh, it's going lower. The trend's your friend. It's going lower. Oil is just, and some people are saying $45. Some people are saying 50. They're all talking a lot lower here. Do you think oil's oversold?
Oh, that's a tough one. And I don't really think that you can say just yet that the worst is over. I mean, I think the mere fact that you didn't have the production change from OPEC, back on Thanksgiving, that
Yeah.
really was that, proverbial kind of game-changing moment. I mean, I think it really caused everyone to wake up and look at the fact that the U.S. is now a much bigger producer on the world's oil market, and you do have a bit of supply glut right now, and there's no evidence to suggest that Europe's economy is going to get better significantly anytime soon. So it's kind of classic economics 101 right now. We know we have a decent amount of supply. Demand seems to be waning, so it's hard to say that oil prices have been oversold or that there's a floor just yet.
And OPEC, I mean, OPEC could do it because they probably have like the lowest cost of production, correct?
Yeah, that would appear to be the case, but you do seem to have this dissension based on what happened at that meeting. The Saudi Arabians and a couple of other countries that were more aligned with the Saudi interest definitely seem to be in favor of keeping things as they were. Now, will other countries that are feeling the pinch more acutely, Russia and Venezuela come to mind, be able to convince other members of OPEC that it is time to take action to try and boost prices? I think that still remains to be seen.
Oh, but aren't there going to be some sectors of the economy that are going to benefit from from the lower crude prices? I
Oh,
mean,
definitely. As I mentioned, yeah. I mean, you're already seeing a lot of retailers talking about the fact that their fourth quarter will likely be even better than expected. A couple of months ago, because of what's been happening with oil prices, Walmart has suggested that. Macy's, Costco had some pretty nice numbers earlier this week. That stock's near an all-time high. The airlines. I mean, talk about a sector that used to be maligned and hated. I mean, now,
Mhm.
if you say someone's the airlines of, they're the airlines of this industry, that used to be a huge knock on them. Now, if you say someone's like the airlines, it's a big compliment.
And if you look at where these airlines have come from too, like if we go back to the Ebola lows there on October 15th, everybody was throwing these things out. It's amazing how that sentiment has turned so much. Like we were looking at the chart of American Airlines the other day. This
Yep.
thing has almost doubled in 2 months. Is this,
Yeah.
has it turned too far now?
I don't know. I mean, the lower that oil prices go, that gives the airlines a lot more cushion on the profit side. That definitely could help them. And as long as demand, that's the key factor. As long as global demand doesn't plunge, then I think the airlines probably, they're in decent shape for the time being. Maybe some of them are a little oversold. You'll have more pullbacks. Obviously, geopolitical headlines can create some problems. But I do think that the difference between the airlines going up on lower oil and the airlines going down on Ebola was that when oil is going down, it's a clear indicator that that's going to help airline profits. It's a pretty easy equation. The Ebola fears were just that. They were fears. It was emotion. It was irrational behavior. People were betting that there was going to be this sudden pullback in air travel because of Ebola, and that just obviously didn't happen. None of the major airlines said that they were seeing any decrease in demand because of what's happened with the Ebola crisis.
You're listening to Paul LaMonica. He's a digital correspondent at CNNMoney here on Benzinga's pre-market prep. Paul, we got a question coming out of the chat here, and can you give us some insight into how the Fear and Greed Index is comprised?
Yeah, that's a great question. I'm glad that someone is asking it. We have a fun video. I can tweet that out again later up on our site right now that shows a little bit more about the Fear and Greed Index, and it's got some great animation as well. When you look at it, it really is. It's composed from 7 different indicators. The VIX is one of them, and what we wanted to do, and we created this a couple of years ago, was to try and find some gauge of sentiment that just went beyond the VIX. So market volatility, as measured by the VIX, is one of the 7. The others, you have put and call options. We're measuring what's happening with the volume there. Stock price strength, the breadth, what's going up and what's going down. Safe haven demand, as measured by what's going on in the bond market. Market momentum, and then junk bond demand as well. So those are the 7 indicators. Right now, the Fear and Greed Index is back in fear. It was only a month ago, actually only a week ago, it was in greed.
Wow.
Before the sell-off of this week. It is very interesting. I mean, it's a very fast-moving number. I mean, it was down as almost as low as you could go in early October when we had the volatility of late September and early October. It got almost to 0. It can't go any lower than that because it doesn't go negative. But, it's a fun indicator, a fun tool, and we have found that, you can, on occasion, use it to try and figure out if things are maybe getting oversold or overbought.
And so when this thing goes down to, say, 0, and everybody is so fearful at that point in time, is that typically when you'll see the market turn higher?
It may not be immediate. I mean, it can stay at 0 for an extended stretch, but it has, we've back tested it, and it has proven that once you get into those extreme fear levels, after a certain amount of time, you do tend to see the momentum shift and investor sentiment improve and the market going up.
Paul, there's a lot of trepidation in the market about interest rates, and couple different viewpoints. We're actually going to have a roundtable discussing the economy for next year and whatnot. Where do you stand? I mean, is this economy in good enough shape where they can take interest rates up a little bit and not send us back into a recession? Do you think the Fed's fearful of what would happen if they raise interest rates? Where do you stand, short term, long term, on interest rates?
I really think that we're at the stage now. It's been 6 years since the Fed took interest rates to near 0. The Lehman Brothers crisis, I think is far enough in the rearview mirror that the Fed can start to normalize interest rate policy a little bit. Now, I'm not suggesting, and I hope that Janet Yellen is of the similar mindset, and all indications are that she is. I don't think the Fed is going to dramatically raise rates, and I think for better or for worse, the Fed, since Ben Bernanke took over and Janet Yellen has continued, they are so transparent now, and they painfully telegraph everything. One problem with that is that all Fed members are now speaking. They all have a little bit of a pulpit, so sometimes the market maybe overinterprets comments from some Fed members that may not be as important. I think the bottom line, though, is that Janet Yellen and the other Fed members that are in her camp, they may raise rates next year because the economy is finally healthy enough to withstand higher rates, but I think it's going to be slow and gradual. I mean, they're not going to go from 0 to 1.5 in a very rapid period of time. They're probably just going to do quarter point hikes here and there, nothing so big that's going to spook the markets.
Aren't we just stuck in this low rate environment forever? Like, how does the Fed ever come and really raise rates significantly? Because the whole economy is built on debt.
It does seem that is a big problem right now. I think the Fed definitely is cognizant of that, and we might be in a cycle of low rates for an extended period of time. But they're going to go up from 0. I think that is certain. I mean, can the economy withstand a Fed funds rate eventually, down the road at 2% or 3%? Because that would still be considered pretty low. Arguably, the economy can withstand that as long as the rest of the world picks up. And I think that's one thing that is key. I mean, right now, the U.S., use whatever metaphor you want, the cleanest dirty shirt, the ugliest house, and the best looking house in an ugly neighborhood, et cetera, et cetera. Right now, the U.S. is doing well despite what's going on in Europe and despite a slowdown in China. I'm not so sure that that can be the case forever. We need China's economy to pick up a little bit. I mean, I'm not saying it's got to go back to 10% growth because those days are probably gone now that economy is as large as it is. But Europe's got to come out of recession and has to fix its many financial problems. And, we'd be nice to see, Japan also become more of, an economic power again, as opposed to something that's just been, we're almost to the point where we're going to be talking about a lost half century as opposed to a lost decade.
Wow.
We got coming out of the chat here from SF Bright TG. Thinks maybe the Fed will just hold steady on interest rates until oil finds the bottom. It seems like that's very anti-inflationary with the cheaper oil prices. Is the lower oil kind of giving them a little bit of leeway here?
I think that is a great point. I think one, I'm not sure if problem's the right word or not. I mean, it could be, but the one issue that the Fed has to grapple with right now is that on the jobs front, things are definitely improving. I mean, so they have to be more satisfied about the employment part of the mandate. But inflation, definitely the Fed, I think, would like to see prices go up a little bit. And what's happening with commodity prices, particularly oil, definitely makes it more difficult, I think, for the Fed to justify dramatic interest rates because, typically, especially if you're Paul Volcker and you remember the 70s and 80s, you raise rates to fight inflation. If they're raising rates when there's no inflation around, that could be a problem. So I think the Fed is more fearful of deflation than, fighting an imaginary inflation bogey. So,
Paul, can you help me out figure out what's going on with Draghi over there in Europe? I mean, I hear you hear one thing that they're ready to set their version of QE, and then you hear the Germans are dragging their feet. You get some rallies in the market off that.
mhm.
I mean, can you make heads or tails of what's going on over there?
I mean, I do not envy Mario Draghi or any of his predecessors. I think the big problem with the ECB and the EU. I mean, when you consider the Fed, I mean the Fed has 12 districts. They have regional presidents. They have other boards of governors, but they're all on the same page because they're all part of the same country. You're not going to have the Dallas district, even though Richard Fisher's pretty colorful character, come out and refuse to do something because he has any power. I mean, he doesn't in that respect. But if Draghi wants to do something and Germany is against that, that's a big problem because he doesn't have the backing of all the sovereign members of many of the European nations. And I think his hands are tied to a certain extent. There are probably things that he would like to do, but they need more of a consensus among all of the nations in Europe. And clearly, as we're seeing with some of the Greek concerns being resurfacing this week, it sounds as if depending on Greek elections, how things go out, I mean, I don't think Germany and some of the other healthier Northern European nations want to be in a situation where they're bailing out the peripheral nations of the South again. So we might, hopefully it doesn't come to this, but we could be hearing about the dreaded Grexit again in 2015. And if Greece leaves the euro, what does that mean for Portugal, for Spain, for Italy? I mean, I don't think you're going to see dominoes falling immediately, but if those questions are out there, that's not a good thing.
Okay, just final thoughts for investors heading into the end of the year with a lot of money managers behind the benchmarks. Maybe some will be locking in profits. The other ones that are falling behind, good luck catching up here. Just final thoughts for our investors.
Yeah, I think, as cliche as it may sound, I mean, if you are an investor with a long-term horizon and not a trader, you just have to resist the temptation to, succumb to the emotions and either panic or get too euphoric. I mean, think about it's kind of like what happened in September and October seems to be almost like a microcosm for, the bull market that we've had since, 2009. If you pulled the plug on, most of your stocks in early October because you thought that what was happening was not going to be just the beginning of a correction, but the beginning of a bear market, you've missed out on the subsequent bounce back, since the turmoil. So yes, eventually we're going to have a real correction, and eventually, we're going to have the markets cool off, and we're not going to have double-digit gains indefinitely because historically that's not how it works. But anyone trying to time the market, I mean, if the pros can't really do it that well, then I think average investors, probably shouldn't try either.
Okay, we've been on the line with Paul LaMonica. He's a digital correspondent at CNN Money. Paul, thanks for joining us. We probably won't speak to you till after the new year, so have a great holiday season, and we'll speak to you soon.
Thank you so much. Really appreciate it. Same to you guys, and look forward to talking again in 2015.
Thanks,
Okay.
Paul.